Thank you, Nikki. We feel like that has been missing in the Madison area, Dane County area. So that's what we're here for. And I am super excited I'm not going to introduce formally because LeMar will tell you all about himself, but he is going to be teaching this. He's taught it many times before, and you're going to learn a lot. So again, if you have questions throughout, you can shoot something through the chat. And LeMar, you ready to take it away?
Good morning, everyone.
Good morning.
All right, so we're going to go, Sarah, thanks so much. And as Sarah said, my name is LeMar Welch. I'm with Novus Home Mortgage, one of the lenders that's part of the group that she was just telling you guys about, where we have gotten together as both realtors and lenders and other partners that are trying to promote the home equity and home ownership and home ownership wealth within our Black and brown communities and people of color here in Dane County and even beyond. And there's a few people I know that not everyone that's on this call is from Madison, but that's okay. We're just trying to promote education and promote the growth and prosperity through home ownership. Home ownership has always been a pillar and kind of the bedrock of growing wealth in this country. And so, you know, it kind of leads into stocks and investments and ownership and tools of that nature. And where I think and what I have seen in my experience, and I've been doing this now for about 23 years, is what I call something that's called generational knowledge versus generational ignorance. And it's not that people are, you know, and when I say ignorance from the standpoint of we just don't know. And this is not stuff that is really brought to us, taught to us, and explained how to get from point A to point B. What are the tools that are necessary to get from point A to point B? Usually, you know, in the past, when you buy a home because other people you've known have bought a home, your parents have owned a home, your grandparents have owned a home. A lot of kids now that are like 20, 21 probably aren't even thinking about home ownership, but it's been drilled into them since they were little. Oh, when you get older, you buy a home and you do this and you do that. And that's has always been, you know, the exact same things that has been, you know, passed down in communities of color. So we want to teach, and what I'm planning to do with this today is to just really kind of break down how do you get mortgage ready. And the reason why this is called Get Mortgage Ready is what is that? What does that consist of? Okay, yep, I want to get mortgage ready. I want to buy a home. I want to get a home. What does that mean and what does that entail? So I'm going to be very thorough in kind of breaking down, you know, what are the underwriters looking for? What is this process? How do we get ready to go through that? So this is I'm going to try to be extremely informative with this. I will say this much. This is my first time presenting. I've always taught this class in person. So bear with me because it's live and it's raw. It's not, you know, presented or recorded. It's just, I'm sitting here right now or standing here right now in a conference room in my office, and we're just going to be live and we're going to be raw. So before I get started, I want to talk a little bit about, I guess, me and kind of how we got this. So again, as I say, I've been doing this now for 23 years. And a little bit of background, because there's some people on this call that really don't know my story and I've never really shared it before. So how did I get into the mortgage business? So I've been doing this now since I was 19 years old. Excuse me. I started selling cars at 16 and went to a car dealership, local Ford dealership in the community that I grew up in Gary, Indiana, and started selling cars when I was in high school. So I would get through school and go home, change clothes, put on a pair of slacks and a little tie with a little clip-on tie, and go to the dealership. And I started selling cars at the age of 16. They gave me the nickname of Similac because they were like, "You're so young, you're still, you know, nursing from your mom." So they called me Similac, which used to be like milk formula. And that was my nickname around the dealership. By the time I was 18, I was working in the finance office. So I worked at a dealership that basically on Saturday would spot, and spot means to give a car if the financing isn't even there. We would spot like 25, 30 cars every Saturday. And they used to run ads back in a paper that was like, everybody rides. So they'd give everybody a car. It'd be one of those like, you get a car, you get a car, you get a car, you get a car. And then I was in the F&I office at 18, printing out the contracts, putting people in cars on the weekend. Come Monday and Tuesday, I had to then call around to all the different banks and try to get these contracts purchased. So, which was a kind of a challenge because not everybody had good credit. So the point of me bringing that up is that kind of honed in my skill of negotiation and how to structure deals. So I really learned structuring at a very early age, and how do you put this together and how do you make this work that it meets when a non-traditional kind of meets the traditional, or how do you make this happen? And so that is really kind of what I consider myself. I don't really consider myself a salesperson. My strength comes in structuring, putting a deal together, taking what we have, putting it to fit into what the guidelines are to be able to make things happen. And that's why I've been successful at this. And I've, again, been doing this for 23 years. October 8th, 1997 was my first day in the mortgage business, and I've been doing it ever since. Been in Madison for about 10 years, and this is my passion. This is what I love. I love to see, people, first-time home buyers, regardless of color, but I especially love to see people of color become homeowners and really achieve homeownership, especially in Madison. You guys know what our growth here as far as the value and where the homes have gone. My girlfriend and I, we purchased our home back in 2013, and just where it has grown from what we paid for it now and what it's worth has just been, it's just been insane, for lack of a better word. So I want that to happen for all of us. Anyone that wants to purchase a home, that wants to have the dream of home ownership, wants to have the dream of building equity, building wealth, and then not only that, but teaching their children and passing it down to the next generations is really what I want to help anyone to be able to do. And it's something that we all can do. So that being said, I'm just going to dive in. Now, this is going from 10 to 12. I am not going to talk for 2 hours. I can tell you that. I've been on Zoom calls, and after about an hour and 15, hour and 20, I'm starting to kind of lull a little bit. So we're going to keep it. I'm probably going to teach for about 45 minutes to an hour. We'll go into the question and answering period. I'm going to give a lot of information. Please take notes, because if there's something that triggers you to want to ask a question or remind you of something, we can do that after the call. I can't really see everyone because I'm standing in front of the camera. So Shai is watching, and he'll let me know. So if anybody has a question, or if I need to pause or do anything along those lines, I can definitely do that. Please feel free to chime in. This is as informal as it gets. And I want you guys to be a part, and my goal is for this to be interactive. So let's get started. The first part is, what is a mortgage? What does a mortgage consist of? So we always hear a mortgage. Oh, I want to get a mortgage, I want to get a mortgage. And I've always told this story. Walmart sells about 20 million drills a year. And this is a number that's been around for, maybe a decade. So maybe they sell 40 million now. But they sell a drill to people that don't want to buy a drill. Every single person that goes to buy a drill, it's not that they're excited to buy a drill. What they want is a hole. And in order to get the hole, they need a drill. And that's kind of why I use that analogy. It's kind of like, that's what a mortgage. I don't know anyone that wants a mortgage, but what people want is to own a home. And in order to get a home, for 99.9% of us, that means we have to take out a mortgage. Now, some people can walk in and write a check, either through inheritance or equity or saving up or whatever. But the vast majority of us, in order for us to buy a home, we need to get a mortgage. And to get a mortgage, we have to go through a process and go through that. And that's what I want to teach today. So a mortgage really is nothing more than a 3-page note and about a 12-page mortgage. The note is like a promise to pay. It's just like any other installment contract that you sign, except that it's usually about 3 pages. It tells how much money the bank is lending you, what your interest rate is, the terms, how much you're going to pay back, and over a period of time. That's the note. The mortgage is what gives you the security interest in the home. So it's basically saying, when you leave that closing table, you are a homeowner. You are the owner of that home. Unless you are in a leasehold, what's called fee simple absolute, that is all you. The mortgage is the bank has a security interest because they have lent you money. And now the money, the mortgage secures that money. So it says that if for any reason you do not pay us back, we then will take back the asset. But it's not the bank's, it is yours. It's recorded at the title company. You are the owner of this land, this piece of parcel, this piece of property, the whole nine. That's really what a mortgage is. And it seems like it's really, really complex because there's so many different avenues that you have to go through in order to get there. But it's really pretty simple. Bank lends you money, you give interest in the house as collateral, and you sign a note that says, I promise to pay the bank X number of dollars on the first of every month for the next 10, 15, 20, 25, or 30 years. And through that, there's, again, the appreciation. So what is the bank looking for? That's kind of where I wanted to get to. So we all know where credit is, okay? We all hear about, oh, I gotta have a 620 score, 640 score, I gotta have this score. I'm gonna get to the credit component of it here, but I first wanna start with what is, because this is the biggest thing that I see when I work with people, is they don't really know what all goes into getting a mortgage. What is the underwriter looking for? So the first thing that we're going to look at is you want to buy a home. All right. So we'll start. Should I make sure? I don't know if I can. If I'm off, let me know. Okay. All right. So let's say you want to buy a home and you find a home and the purchase price of that home is $200,000. Okay. So if the home price is $200,000 and you want to purchase it, okay, most of the time you are going to be required to put at minimum 3% of the purchase price down. So if you're looking to purchase a $200,000 home, the bank is going to look to you with some of the different products. Now, you probably have always heard, you got to have 20% down, and that's always been the kind of the caveat, and we'll talk about where that whole 20% down came from and why it's different now. But now, in 2020, at minimum, you're going to put down 3%, okay? So if you're buying a $200,000 house, 3% is $6,000. So the first thing you're going to have to do is you're going to be looking at a $6,000 down payment. So $200,000 is the purchase price, $6,000 is the down payment, and then you're going to take out a mortgage for $194,000. Okay, so you're giving the seller $200,000 through the form of you've got a $194,000 mortgage that you're taking out from the bank, and $6,000 of a down payment is coming from you in the form of either a gift, cash that you have on hand, money that you've saved up, things of that nature. Now, you hear different programs. There's a 3% down. That's for kind of like a first-time home buyer, different income or different asset levels. Typically, though, a standard conventional is about 5%. So at minimum, 3%. Standard would be about 5%. So if it was a $200,000 home and you're not getting any type of, you're just getting like regular, what would we say, conventional financing, this $6,000 then becomes $10,000, and then you're getting a mortgage for $190,000. So that's the first place to start right there, okay? So we now know, all right, I got to come up with money for my down payment, minimum 3%, but probably around 5%. Where am I going to get that from? Where's that money going to come from? And those are some of the things that we're going to dive into. Now, coming back to that, you're getting a mortgage, $194,000 or $190,000. Let's talk about what a mortgage is. So the mortgage, everyone's kind of heard of Fannie Mae, Freddie Mac. Mortgages are really broken down into two different programs. You either are getting a conventional mortgage or you're getting a government mortgage, okay? So a conventional mortgage is where you hear, that's your Fannie Mae, that's your Freddie, and then that's anything that's considered to just be like a bank portfolio, okay? A government loan or government mortgage is, if you've heard of FHA, VA, or USDA. FHA standing for the Federal Housing Administration, VA standing for the Veterans Administration, and USDA standing for the U.S. Department of Agriculture, okay? So these are all different kind of mortgage programs that we can look at, and depending on where you're buying, how you're buying, where you fit into the credit score process, where you fit into LTVs and all of that, basically will determine which type of mortgage that you would fit into. Now, any mortgage that is not a government mortgage is a conventional mortgage. So when you go to Summit Credit Union and you get a 12-year mortgage, that's a conventional mortgage. When you go to, some of the other local banks, and if it's not backed by one of the agencies, then it's something that the bank is holding on their portfolio. So that's kind of like a bank portfolio. That's a conventional mortgage. If you're getting an FHA, a VA, or USDA, VA meaning you're a veteran, you qualify for a program for 100% down financing, 100% financing, USDA the same. FHA is another one, probably the most popular one outside of conventional, and that's where you need the 3.5% down. And that's basically the Federal Housing Administration is telling banks, make the mortgage, accept 3.5% down. If it qualifies, we insure the mortgage, and they promise to pay the lender back if for any reason you had to go into foreclosure, okay? And this kind of in a nutshell really is, the differences between what type of mortgage that you get. Is it a conventional mortgage? Is it a government mortgage, okay? Now, that being said, I want to start to kind of dive into what is it that we're looking for. So let's say you come to me and you say, hey, LeMar, I want to buy a home. First thing I'm going to say is, great, you want to buy a home, okay? Have you looked at homes, before we even start that, have you looked at how much you can afford for a home. What do you want your monthly payment on your home to be? Okay. I have people that come and they want to buy $400,000 homes, and they don't want their house payment to be more than $1,000 a month. And the first thing I say is, I want to buy a $400,000 house too, and I don't want my payment to be more than $1,000 a month. But unfortunately, that's not a realistic goal. Okay. So the first thing we have to determine before you even start looking at homes, buying homes, thinking about how you want to put this, the first thing that I look at is, what can you afford? Okay. I have seen a lot of people will find a house and they love this house and they love this, but then they move into the house and they buy something, and I may not recommend it, or some other people may not recommend it, but they may be able to get financing for it. It creates something that is called house rich, cash poor. Okay. And what house rich, cash poor means is that you move into this house and it's great, except now you're struggling to make the payment on the house, and you're struggling to come up with this monthly payment and this obligation. And then you go, and I've seen this so many times before over the course of my career, you get to a point that you now hate the house, okay? Because you can't do anything else, and it's just eating up. So, you know, you're monthly, you're struggling, so you may have to work a second job, you have to do whatever, you can't take your kid on a vacation, you can't do certain things, and you quickly go from having a house that you like to a house that you hate, because the obligation to make this is basically draining. And so the first thing I tell anybody, it doesn't matter what you qualify for, it doesn't matter, your income may say, oh, you can buy X, what are you comfortable with? So that's always my first question. What monthly payment are you comfortable with making? Then you cater the house around that. That's what's going to make sure that you're buying a house that you like and that you really enjoy.
Okay, wait, LeMar, hold on, I have a question.
Yes.
So we kind of went through the government loans and the different types. When we're talking about conventional mortgages, we're talking about 15-year fixed versus ARMs versus 30-year fixed. Is that, because we can't really read the three things that are under conventional.
Ah, okay, got it. All right. And I'm coming into that, Sarah, talking about, you know, like the different programs.
Okay.
I'm gonna get to that, but good point. Thank you for bringing that up. Okay, so we're gonna kind of go over the numbers really quickly of this is how mortgage lending calculates this out and how they look at this. So let's say you and, I'm gonna say spouse, believe it or not, that's almost becoming a non-traditional, and it's more, you know, a partner or something along those lines. But let's say you, for all intents and traditional purposes, we'll just say you and a spouse. You and a spouse want to purchase a home, okay? You make $20 an hour at your job, your spouse makes $25 an hour at their job. Both of you are working 40 hours a week, okay? So if you're at your job and you're making $20 an hour and you're working 40 hours a week, that's $800 a week. You know, so over the course of a year, you're making $41,600. Okay? Your spouse, $25 an hour, 40 hours a week, 52, that's 52,000. So that means that you have a household income, and the definition of a household income is what is the income of the people that live in the house over the age of 18 or who's going to be in the mortgage. You have a household income of $93,600, okay? Now, in the mortgage business, what we do is we take your hourly rate, which is 20 hours a week, like $20 an hour. We multiply that by the number of hours that you work a week, which in this case is 40. So that's $800 a week gross times 52 weeks in a year. That was the 41,600. And then we divide that by 12 monthly payment, by 12 months. And that comes out to be $3,466.67. Okay? So if you're making $20 an hour, your gross monthly income from the mortgage side or the mortgage standpoint is going to be $3,466.67. Your spouse at this number, same thing, except we were at $25 an hour. times 40 hours is at 1,000, times 52 is 52,000, and then divide that by 12. 52,000 divided by 12 is 4333.34. So we put that up here. So between you and your spouse, your monthly income for the purposes of mortgage qualification is $7,800.01. Okay. So when we get ready to qualify you, you're going to be qualified on your monthly income. Okay. That monthly income is now at $7,800 a month.
But they're
Doesn't sound like a lot. Okay.
But they're going to look at your income. They're going to look at your income before taxes, right? Not after.
Correct. Correct. They're going to look at your gross. And that's why I say it's important, not so much what the bank tells you you qualify for, but what do you feel comfortable with, okay? Because the bank is only going to look at the items that are on your credit report. And we're about to come to that. But they're not going to be worried about what are you paying to MG&E? What are you paying to Lion? What are you paying for school transportation? What is your gas budget? What is your car insurance? What is your food obligation? They're not looking at any of that. So you have to be the one that decides, you know what? I feel comfortable with a payment of $1,500 a month. Or I feel comfortable with a payment of $1,800 a month. Or maybe your rent right now is $1,600 and that's comfortable with you. But if you go to $1,900, then you're getting out of turn. Let me get one sip of water, 1 second. And again, first time I've done this virtually, so just kind of bear with me. So
it's
again,
awesome.
Huh?
It's awesome. It's awesome. You're doing awesome.
All right. So we're at we say $7,800 a month for your combined household income. Now, what the bank is going to look at as far as their guideline, all right, I'm being told it's right there. So according to the bank, between your household income of the two people, you and your spouse, you're making $7,800 a month. The maximum that you can have for debt obligations, this is the payment on the new mortgage and all of your other monthly bills and monthly obligations, is 45%. Okay, so we would take 7,800 times 45%, and that comes out to $3,510. Okay, that means in this number, everything needs to fit in that number. Okay, your housing costs, your car notes, your student loans, your installment loans, anything that you make a monthly payment on, your credit cards, anything you make a monthly payment on, we're going to take those monthly obligations and and the new housing payment plus those obligations cannot exceed $3,510 per month. Okay. Now, if you're looking at an FHA program, it can go a little higher. And there are some changes to this, but I'm just going to stick with the traditional, what is, 45%. Okay. Now, you say, all right, I'm paying $1,700 a month in rent. And I know some people on the call and be like, who's paying $1,700 in rent? Some people are. Okay. Maybe you're paying $1,000, maybe you're paying $1,200, but this is just for, demonstration. So let's say you're paying $1,700 a month in rent right now. You say, you know what, I'm comfortable there. I do not want my house payment to be more than $1,700 per month. Okay. So we set that threshold. $1,700. Now, a mortgage is your mortgage payment is going to consist of something that is called PITI. Okay. PITI. That is principal, interest, taxes, and insurance. Okay? Principal and interest is the payment that goes to the bank. That's still what you borrowed. You know, you borrowed $194,000, and we'll get into the interest rates and different things like that. But this is basically the bank payment. The taxes are the property taxes that are on the property. So if you're buying a home here in Dane County, you might be looking at property taxes being $4,800 a year. So if your property taxes are $4,800 a year, you're making 12 monthly payments, you're going to divide that by 12. That means that your monthly taxes are going to be $400 a month, okay? If you get homeowners insurance, now what is homeowners insurance? Homeowners insurance is what protects the house. So if your house burns down, the homeowners insurance policy kicks in to cover that. If you, let's say your kids running the water on the upstairs, they leave the water running on, and then all the the water overflows in the bathtub, and now you've got this big leak in the bathtub, and it all comes crashing down into the first floor, which has happened. Okay, that's what homeowners insurance covers. It covers the house. It's also called hazard insurance against a hazard, but that is what this insurance is. Typically, it's going to run anywhere between $900 to $1,200 per year, depending on who your carrier is. Let's just say, for all intents and purposes, let's just say $1,200, just to make numbers simple. Divide that by 12, that's $100 a month. Okay. Now, this is what's called PITI. And under conventional, if you put the 20% down, you're not going to have mortgage insurance. But if you don't put 20% down, then you're going to have something that is called PMI, or private mortgage insurance. What does PMI consist of? PMI, for lack of a better term, it is an insurance policy that the bank makes you take out to protect them in case you go into foreclosure. So if you stop making payments, the private mortgage insurance company will kick in and make the difference, pay the bank the difference between 80% and what you put down. So if you put down 3%, then the private mortgage insurance, or PMI, is going to cover the extra 17% that the bank lent you, okay? Because the bank really wants to be at an 80% threshold. And we'll get into that number of why in a minute. So you will have something called primary mortgage insurance. So you have PITI, and if it's 20% or less down, then you're going to have PMI. And let's just say, just to make this really, really simple, let's say your PMI is $100 a month. Depending on the house that you buy and the interest rate, there's a lot of factors that go into that, but let's just say that your PMI is $100 a month. Bear with me because I don't have my glasses, so I'm trying my best to make this look and go where we need to go. So if it's too small, too big, or anything, just let me know. I'm struggling with size right now, okay? So if your taxes on the home that you want to buy are $400, the insurance is $100, and the PMI is $100, that's $456. That's $600 a month right there. You're comfortable at 17. That leaves you at $1,100 that can be principal and interest for you to be at that comfortable payment that you want to be, okay? So before, and this is where I always have a lot of people, I found this house and it's $350,000. And I had a lady a couple of weeks ago, she literally called. She's making $14 an hour at her job, but she's seeing $300,000 homes. And I can tell you in Dane County, Wisconsin, a $300,000 home at minimum is going to run you about $1,900 a month at minimum. And can you afford that on a $14 a month? $14 an hour job? Probably not. And you definitely can't, because you're not going to hit the DTI threshold of 45% at that number. But this is why this is important, that you start to sit down and really kind of break down what all is this going to entail to get to that mortgage payment. Okay, so if we want to be at 1,700, 600 is already allocated for our property taxes, our homeowners insurance, and our primary mortgage insurance. That leaves us $1,100 a month. Okay, how much house can we buy on a fixed 30-year mortgage with a monthly PNI of $1,100 a month? Okay, so right now interest rates are ultra low. Everybody knows that everybody's looking for a home. So let's just pull out my handy dandy financial calculator. Let's say for $1,100 a month, and I pretty much from my own house bank, I almost can kind of pull this out. So let's say at 3%, I'll say 240,000. We'll say at 3% for 30 years. See how close I am. Okay, it's 1,011. So we actually can go a little bit more. So let's say 260. Okay. So if you were getting a 30-year fixed rate mortgage today, and your interest rate was 3% on a 30-year fix, and you wanted to get your principal and interest around here, that means that your loan or your mortgage could be $260,000. Okay. Assuming that taxes are $4,800, insurance is $1,200, and we're keeping the PMI at about $100 a month. So at $260,000, your mortgage payment would be $1,096.17 a month. So $1,096.17 for the P&I, $400 for the taxes, $100 for the insurance, $100 for the PMI. And if my math is right, that should be at $1,696.
Can you real quick go back? Can you real quick go back over the like what is matching up with what? So the $400 is the what? The 100 is the what?
Sure, absolutely. I don't know if I'm moving over here. Not yet. I don't know. Can you all see over here?
Yep, we can see you.
Okay. All right. So this here is the P&I, principal and interest. This here is the property tax, the 400, the property taxes. $100 for the insurance, the homeowner's insurance, and this $100 is your insurance for what we call PMI. We all hate PMI. The reason why is because we really get no benefit from it. PMI is a policy to protect the bank, not to protect us. But I kind of call it one of those necessary evils because it allows us to have a home when we don't have that 20% to put down. And before, and again, I don't want to go too technical. I don't want to go back to 1934 and talk about Freddie FDR. But before, you couldn't buy a home unless you had 20% down. Then some insurance exec came up and said, hey, why don't we come up with a way to insure this part so that people can't, because they can't come up with 20% down. And it really kind of happened when the price of houses exploded right after World War II. And anyway, I'm not going to get to a big history lesson, but the PMI is kind of a necessary evil because if you don't have 20% to put down, you can still buy a home and only come up with 3% down or 3.5% down. You just have to carry mortgage insurance to cover the bank in case you go into default.
And
Okay?
then LeMar?
Yes. Yes.
So usually when someone puts down 3.5% based on appreciation, after how many years would they refi to be able to remove that PMI?
Sure. Okay.
Because one of the goals is to remove it, and if we look at how appreciation works, then the house, then all of a sudden there will be 20% in there.
Yes. Yes. And I'll get into that here in just a little bit of breaking that down of the appreciation to break down the PMI. But basically, right now here in Dane County, we're at about 4% appreciation per year. So if you were getting a conventional mortgage, you probably would in about 5 years would be able to refinance and get out of the primary mortgage insurance. If we look at just the last 12 months, I mean, housing has been going up even higher than 4%. But I think a good rule of thumb is about 3 to 4% appreciation per year. The last several years, I mean, obviously we have a housing shortage. We have far more people looking to buy homes. Because of the crisis, a lot of builders and not as many homes were being built, so the stock was starting to change a little bit. So we're starting to see higher appreciation, but typically 3 to 4% is typical. So if you, let's say 4%, in 5 years, you will reach 20% of equity. So usually within about 5 years. But now if you take out an FHA mortgage, as of right now, and when I say right now, because things always change, the mortgage industry is a living, breathing entity. And it doesn't matter whether you've been doing mortgages for 6 months or 40 years. You are learning every day because it's changing every day. It is its own living, breathing thing. Before, with 3.5% down, that's an FHA mortgage, okay? Before, with FHA, you only had to carry mortgage insurance for about 10 years or 11 years. But if you take out a policy of mortgage, FHA mortgage now, PMI is for the life of the loan. So as of right now, if you get an FHA mortgage, you pay PMI for the entire life of that loan. So obviously, you're going to want to refinance out of that within about that 4 to 5 years and switch from an FHA to a conventional loan. And we'll look at what costs you to have to go FHA. And if you have to get an FHA mortgage, you get an FHA mortgage. I would never tell anyone not to buy a home or become a homeowner because of a mortgage product. You get what you need to get into the home, and then you can always look at it getting into something or improving into the set of that a little bit later down the line. So coming down here, this payment that we were talking about where you're at $1,700 a month is where you want to be. You can buy a house up to about $260,000 or get a mortgage of $260,000. Anything above that is going to be your down payment. So if you want to buy a house for $275,000, you can buy a house for $275,000, you get a mortgage for $260,000. You're going to be putting down $15,000. You could buy a $500,000 house. You're going to get a mortgage for $260,000. So you're going to put $240,000 down on a $500,000 house. You buy whatever house you want to buy, but based upon this qualification, this is what your mortgage you're going to get, and then anything over that is going to be you bringing that to the table. Does that make sense? Is everybody up to speed on that? I want to make sure I'm not losing anybody. Sarah, how are we sitting? We're sitting good?
Yes, we are. It is good to pause every once in a while. So I know that's a lot of information, but
it is.
Yeah, no, this is awesome. We're good. Keep going.
Okay. All right. So that being said, so this is how we get to the qualification process. Okay. So let's say we go out, we find a house. The house is $270,000. We're going to put $10,000 down. We're going to get our mortgage for $260,000. Our monthly payment is going to be $1,696. We're good to go. Okay. Now we're going to come to what is the next thing. All right. Now the next thing that we're going to look at, now that we've got the threshold of what our house payment is going to be, coming back to that analogy that we put together before about the partners, you and your spouse, you're being at $3,500. I think it was $3,510. We're using $1,700 for the house payment. Okay, so to qualify for this, get my calculator out. $3,510, $1,700 is going to be used for housing. That means that we only have $1,810 a month left over for everything else. That means your credit cards, your student loans, your car loans, your installment loans, your furniture bill, all of that cannot exceed $1,810 a month. Okay, because your housing payment is going to be at $1,700, so you have this left. All right. Now let me get into student loans, because this is probably the biggest one out of any type of loan that's out there. A lot of us, especially here in this area, are very educated. We have degrees, bachelor's, master's, even at the doctorate level. So a lot of us carry student loan debt, okay? If you're in something that's called an income repayment plan, which I come across a lot of people that are, their student loan payments are based upon being an income driven. That's fine, except for in a mortgage. In a mortgage, they understand that your income could potentially fluctuate. So mortgages-based student loans off of what is called your fully amortized payment, okay? So if you've got $100,000 in student loan debt, and your interest rate on that $100,000 in student loan debt is 4%, and they give you the extended term of 25 years to pay that off, that's going to give you a payment of like $527 a month. Even if you're not paying that on your student loans, that's what's going to be assigned as your monthly payment for your student loan. So even if you're on an income-driven plan and you say, you know what, I've got 100,000 student loans, but I'm only paying $150 a month towards my student loans, that's great. But you're going to be based off what's your fully amortized student loan payment, okay? So let's say 527, all right, for right now. Most of us have car loans, okay? Average car loan right now is $450 a month. So $450 a month for one car. Your partner has their car note, we'll just say $300 for there. And let's say you both got $50,000 in student loan debt each. So we'll just go $500 for student loan debt. You bought furniture, so you got a furniture loan because you all went over to Bob's Discount Warehouse, and now you're paying $150 on the furniture loan. And then the minimum payment on the credit cards, because you have a few credit cards, is $100 a month. So $450, $300, $500, and $250 puts us at $1,500 a month in your monthly obligations that are reporting on your credit report, okay? So in a scenario like this, you're looking at $1,700 for your housing payment, $1,500 for your other obligations, that comes up to $3,200. So when we're calculating out what's something called, okay, when we're calculating something out called your debt to income ratio or your DTI, your debt to income ratio means your income is 7810. Your obligations are 3,200. So 3,200, this is your debt divided by your income, 3,200, divide that by 7810. That gives you a debt to income ratio of 41%. Okay? So you will hear things called DTI. Okay? And you go to a bank and they're calculating things out. Well, what is your DTI? What is your DTI? That is your debts. What's on your credit report is $1,500. The new house payment is going to be $1,700. That's going to be that. And what I'm talking about here is called debt to income. Okay, so your debt to income, and when you hear DTI in the field, you're going to hear, you talk to anybody in the banker, oh, your DTI is this, your DTI is that. Well, what's your DTI? What's your debt? That's your debts, the new housing payment, plus all your other obligations, divided by your income, gives you a percentage. And that's what we base that on. And as I said before, remember I was saying before, I said you're going to be that 3510 is 45% of your income. That's usually your maximum. So in this case, you and your spouse could buy that $260,000 house, still meet all your other obligations, and you are under that 45% threshold. You now have a debt to income ratio of 41%. So could you buy this home? Yes. In this particular standpoint, you could buy this home. Okay. So this is how, for qualifying for a mortgage, and I wanted to break this down and really go over the income component of this. This is how the income is looked at as to what you can qualify for a mortgage. Any questions before I go on to the next stage? No? Okay. All right. So we've got our debt to income ratio down. We know kind of where we are as far as the mortgage is concerned. The next thing that we want to go to, and Shia, this would be a great time to bring up that threshold, that shot that I was talking about. The one slide. Guys, give me 1 second. I'm going to bring up a slide to come to the screen. Okay, so looking at this slide, can everyone see this slide right here? Oh, give me a second.
Not yet. There we go.
Okay, so you see where it says at the top, it says maximum LTV ratio requirements for conforming and conventional mortgages. So when you look at this first top one here in the green, it says purchase and no cash out refinance mortgage. So it says here mortgage purpose and property type. For 1 unit primary residence, your maximum LTV is 95%. So what is LTV? LTV is what is called loan to value, okay? So in the mortgage world, we take the value of the asset, which is the purchase price, and we will give you a percentage of that loan amount. So a loan to value is the percentage of the loan against the purchase price. To make the numbers simple, we were talking about a 260. We're just going to make it simple. Let's say you're buying a house that was $100,000. Okay. And I was saying before, you could only put, we have a program where you can put 3% down. That means that you would put down $3,000 and you would get a mortgage for $97,000. And then that makes up to what your value is going to be. Okay. The slide's still up. Okay. And then you come down under there and you start to see you got what's called a 2-unit primary residence, and it goes up to 85%. And then if you got the 3 to 4 units, it goes up to 80%. So that's a breakdown of what the different values that you can reach if you're qualifying for a mortgage that's through Fannie Mae or Freddie Mac. So if you were buying, let's say you're buying a 3-unit or 4-unit, you want to buy a 4-unit home here in Dane County, then Fannie Mae is going to say for a 3 to 4 unit property, your maximum loan to value is 80%. So in that case, you would have to put 20% down if you were looking to buy a 4 unit property anywhere in the country. Actually, I'm just saying Dane County because that's where I'm based off of. Let's say you wanted to buy a 4 unit property, but you did not have 20% to put down. Then that's when we look at other mortgage products. The first one being an FHA. An FHA will allow you to actually purchase any 1 to 4 unit residential property with 3.5% down. So FHA, even though you could not go conventional, you'd have to put 20% down on a multifamily for conventional, you could purchase a 4 unit under FHA and still only put down 3.5%. This matrix I wanted to bring to the screen was so that you could see this is what the banks look at. So these are the percentages and the ratios that we're looking at when we're trying to get homes to conform to Fannie and Freddie. Okay, you can bring me back to the slide. Okay, so again, now on the other slide we were talking about, it said 95%. So again, $100,000 asset. If the maximum loan to value is 95%, that means you're putting down $5,000. You're taking out a mortgage for $95,000, and then you get to your purchase price of $100,000. And that breaks down. So that's how we kind of come to what are our loan to values. So if you want to buy a $300,000 home, you're going to be looking at a minimum, as I said earlier, of 3%. 3% of 300,000 should be 10.5 unless my math is wrong. So if you're going to buy a $300,000 home, you're going to be looking at putting down $10,500. That may come from gifts. That may come from other different type of avenues. And we can, again, not to go too deep into this, but we can talk about how do we get to that down payment component. But I do want to move on and still kind of talk about some of the other things as well. All right. So we've covered loan to value, we've covered the mortgage, we've covered kind of what consists of that mortgage. The next thing now is, and this is the one thing that we all hear, what is our credit? What is our credit score? Where do we need to be as far as a credit score is concerned, and how our debts are in order to be able to qualify for a mortgage, okay? For a conventional loan, you need a credit score of at least 620. Now, a lot of you guys will go to Credit Karma. Credit Karma, and I want to make sure I'm definitely stepping on this one. Credit Karma uses something called a Vantage score, okay? And when you look at Credit Karma, you hear this thing called Vantage. It's a Vantage score. So I get people all the time, they're like, oh, my Credit Karma score is a 638, or it's a 655, or it's a 720, okay? But there's a difference between a Vantage and what you probably hear is called FICO, all right? So a FICO score, when you hear FICO score, FICO stands for Fair Isaac and Company. Okay.
Can we get the writing a little bit bigger?
Yep.
Please?
Yeah, Shai's been telling me that. I'm sorry. I tell you, bear with me. My vision is not the greatest right now, but I'm working. So we got FICO score. And FICO stands for Fair Isaac and Company. Now, why is Fair Isaac and Company important? Because they created the algorithm that generates your credit score. And your credit score is based upon a percentage. I don't know if we're able to bring that slide up or not. The one I had about the breaking down a percentage of what your payment, of what your credit scores consist of. So your credit score is going to consist of things like your payment history. It's going to consist of things like your the time that you've been on that you've had an account open. Have you had any late payments? All of that kind of breaks down into an algorithm that gives you a credit score. This company, Fair Isaac and Company, created the algorithm that assigns a numerical score to each trade line on your credit report. And so they shortened this, Fair Isaac and Company, FICO is what your FICO score is, okay? Credit Karma does not use the FICO score. It uses a Vantage score. Think of it like Tylenol and Equate. Tylenol being the name brand. And let's say you go to Walmart and you buy acetaminophen as under the Equate brand. I'm not trying to in no way bring Vantage score down, but the name brand, the people that kind of created the product is Fair Isaac. Vantage score uses a algorithm very similar, but it's not the same algorithm that the lenders use. The lenders are still on the name brand version, if you will. They're still on the Fair Isaac. You get Credit Karma for free because the Vantage score is not the typical score or the industry use score, okay? So that's why sometimes you could have a Credit Karma score. And if you've ever gone to Credit Karma and then you went to go apply for something and you found out you had a different score than what your Credit Karma score says, that's what this entails and that's what this means. You may pull your Credit Karma score, you may go on there and they may say your TransUnion Credit Karma score is 680. And then you go get your credit pulled at, Russ Darrow because you want to buy a Jeep. And Russ Darrow says, well, your score is 633. And you're like, wait a minute, my TransUnion is 680, it's not 633. Well, we just pulled your TransUnion 633. Well, Credit Karma used a Vantage score, and that algorithm was based upon Vantage score. Russ Darrow pulled a FICO score, and that's where your FICO score, so that's where those algorithms are different. And I get a lot of confusion around what those differences are. I don't want to get too deep into, what that is or how it entails. I just want to make sure that you know kind of the difference because that's a big one that comes up. What is the Credit Karma? I get Credit Karma, and then there's also kind of what the FICO score is. So in the mortgage industry, we're looking at three things, okay? Now, all of you have heard of the three major credit bureaus in the US. You've got TransUnion, you have Equifax, and you have Experian. All three of these bureaus are going to give you a credit score. So let's say I was to pull your credit today and you were to get, let's say a 683 on a TransUnion, a 702 on an Equifax, and a 735 on an Experian. And the question may be, well, why is there a difference? Why is the TransUnion different scores? The main reason for that is that they're just going off of the information that's reported. Not every company, not everything gets reported to every bureau. You may have a small credit union auto loan here in Dane County with maybe a small credit union, okay? They may only report to one bureau. So your car payment or your car loan may be on your TransUnion report, but it's not on your Equifax or your Experian report, or vice versa. Let's say you have a credit card and they're based out of Nevada. They may just be reporting to your Experian. That may not be showing up on your other bureaus. That's why the mortgage industry pulls all three credit bureaus so that we are making sure we're hitting all of your debt obligations, everything that's out there that may be reported on one bureau that's not reported on the other bureau. And that's usually why you have those three scores. The mortgage industry, because this is set by Fannie and Freddie, says that for mortgage qualification purposes, we are going to take the middle of your three scores. So in this case, TransUnion would be your lowest score. Experian would be your highest score. And then Equifax 702 would be your middle score. So we're going to qualify everything off the 702. Your interest rate is going to be based off the 702. The maximum debt to income, your DTI is going to be based off the 702. The interest rate, your PMI, all of that, for everything as far as the qualification is concerned, you will be based off of your credit score of 702. Okay. Any questions on that so far? Okay. So we generated, we know our LTV, we know our loan to value, we know our debt to income ratio. We've now justified that we can qualify for this mortgage based on the amount of money we make. We're comfortable with the payment. We have now seen, based on our credit score, that this is what we're going to be based off of, a credit score of 702, okay? And let's say at 702, you can qualify for that 30-year at the 3%. Now, Sarah was talking earlier about what are the different type of loan programs. So in the mortgage industry, there's different loan sizes that you can do. You can do a 30-year mortgage, and this is by far the most common mortgage that anybody takes out, okay? You have a 15-year mortgage. I'm sorry. You have a 25-year mortgage as an option. You have a 20-year. You have a 15-year. And then you have a 10-year. And these are all your different options as far as how long do you want to finance your home for. For some people, they want to be able to have the lowest possible payment. And to have the lowest possible payment, they're going to go the route of the 30-year mortgage. Some people will say, I'm 55 years old. I do not want to take out a 30-year mortgage. I want to have my house paid off when I retire. And then they may want to take out a 10-year mortgage. Or the payment, and that payment is going to change and adjust based upon the different loans, the loan term that you take out. So as I was saying earlier, your note consists of your interest rate, the amount you borrowed, and the term. These are the different mortgage terms that are available. You do not necessarily have to take out a 30-year mortgage. You can do a 25, a 20, a 15, or a 10. Now, this is under agency, which is where we was talking about Fannie Mae and Freddie Mac. I can tell you some people here in Dane County are familiar with the rapid refinance because Summit Credit Union offers something called a rapid refinance, which is like a 12-year mortgage. That 12-year mortgage is what's called a portfolio. Agency, meaning Fannie Mae and Freddie Mac, do not offer a 12-year mortgage or 17-year mortgage, but other lenders that keeps that loan on their books can customize the term of their loan to basically what they want to customize it to. But for all intents and purposes, we want to say agency, okay? And you guys heard Sarah mention a little while ago, a fixed or an ARM, okay?
I'm gonna, while you're typing this up, someone asked if there's a penalty to pay off early.
Not under an agency product. Prior to 2008, when it was kind of called like the subprime world, if you will, you could have a prepayment penalty on the loan. It's basically saying you take out a loan, if you pay it off within the first 2 years or 3 years, you'll pay a percentage as a prepayment penalty. That's all gone now. Under anything agency or government, there is no prepayment penalty. So if you're standing in line in front of me at the gas station and you get that scratch off or you get that Powerball and you hit it for $150 million, even if you took your mortgage out the day before, let's say we were at the closing table and then you got that went and bought that Powerball and you hit that $150 million, you could pay that mortgage off the next day. Now keep in mind, there will still be a LeMar fee connected with that, okay? So there's gonna be that little bit of sharing of the wealth, if you will. Remember, this is about wealth sharing. So if you hit that $150 million, don't forget me at that time, all right? So that was the joke. I remember I said I was gonna try to throw some jokes in there, or maybe it wasn't funny, but that was my joke. So no prepayment penalty, you can pay off at any given time, okay? So a fixed and an adjustable rate mortgage basically means that the interest rate that you get on a fixed will be fixed for the life of the loan, okay? So if you take out a 30-year interest rate and your interest rate is 3%, that means that you will pay 3% for the life of the loan, okay? Now, if you get something that's called an adjustable rate, or an ARM, which is an adjustable rate mortgage, you may get an interest rate that's lower than the 3%, but it won't be for the entire life of the loan. And perfect, thank you. Why would that be important, okay? Let's say you know you're not gonna be in a house more than 5 years, okay? So if you know beyond a shadow of a doubt, and I see this a lot, we get, especially here in Madison, we get, professors that come in or here on assignment or what have you, and they want to purchase a home, but they know they're only going to be here for 5 years or 7 years. And so you may get offered 2.625 on something called a 5-year ARM. Same program, but if you know you're not going to be in the home for 30 years, why take out a 3-year if you can get the same mortgage at 2.625 and pay a little bit smaller payment? Okay, not something I recommend because now the differences between the two really aren't that big. Now you're going to probably maybe a quarter, but unless you just are absolutely positively sure, you're not going to be in that home for that 5 years. I'm not a big fan of recommending adjustable rate mortgages, but they are there and they are available, and we can definitely look at the different options that are available if you wanted to do it all. Okay, Some people know, hey, we haven't started a family yet, so we're going to buy the small home as a starter home. We know we're going to start a family in the next 5 years, so this is just going to be a home for us for right now. We know we're going to need bigger a little bit later down the road. We know that we're going to be doing a stepping stone. We then could consider doing an adjustable rate mortgage. And they come in the forms of a 3-year, 5-year, 7-year, and a 10-year, okay, for those options. And typically, you get a lower rate than you do on a 30-year mortgage. Now, because of just where the market is, there's just not a huge difference in them, but they are there and they are available, okay? What else do I want to cover as far as mortgages? Okay. Oh, all right, got it. Okay, so we talked about student loans, we talked about car payments, we talked about all the other different things that are going to get us to the qualifying standpoint of what we need to do to get the mortgage. Okay, so now we're ready. We've looked at, we know our credit score is 702. We know between us and our spouse, we are at $7,800 a month for housing, for income. We know that we've added up all of our other debts based upon our credit scores, all of that. So now we're ready to talk about that. I want to go back to the 702 credit score. Shai, let's bring up that slide. What does your credit score, what is it based on? What goes into a credit score? So we're going to bring the slide up here in just a second. You guys see the slide where it says what's in my FICO score? Okay.
Yes.
So, yeah. So when you're looking at this, that FICO score 702, 30% of that is the amount that you owe on that debt. Okay. So depending on what your 30% of your score is, what is the amount that's owed? But you guys see at the very below that, 35%. So 1/3 of your FICO score is based on your payment history. How do you pay your payments? Are you late on your payments? 10% is the credit mix. 15% is something called the length of the credit history, and then 10% is your new credit or new debts or new obligations. But I want to really focus on the payment history because that is the biggest one. All right. So what causes a late payment? Am I back on the screen? Okay. What causes a late payment? All right. If 35% of your credit score is your payment history, you want to make sure that when you're making payments, you are never 30 days late. How do we generate that 30-day late? Let's say you have an obligation, the payment is due. Let's take a mortgage. On your mortgage, your payment typically is going to be due on the 1st of every month. So if you were to buy a house today, right now, this is October 8th, your first payment would be due December 1st. Okay. So we said that payment was $1,700. First payment would be due on December 1st. And on the 1st of each month thereafter, your payment, January, February, March, April, May, and on for the next 30 years is going to be on the 1st of the month. So on the 1st of each month, your payment is due. Okay, that's $1,700. Now, you have, according to the Fair Credit Reporting Act, and everyone, all the banks and everyone follows the Fair Credit Reporting Act, you have up to 30 days to make that payment before that payment is considered a late payment. So if your payment is due on December the 1st, you have up until December the 30th for that to not affect your credit, okay? But if your payment was due on December 1st and you don't make that payment till January 3rd, you now have a 30-day late on that particular obligation. Okay, and that 30-day late will be recorded on your credit report. And so when it talks about payment history, you now have a 30-day late. Let's say your payment is due December 1st and you make that payment on February 14th. Now you have a 60-day late because you are now considered to be 60 days late on that obligation. And any obligation that reports to your credit report still follows that same 30, 60, 90, 120, 150-day late process, okay? After 150 days, the belief for everyone is that you're never going to pay the debt, and it's usually when it goes into default. And if you bought a home and you haven't paid in 5 months, the foreclosure process starts and all of that. But all of this affects you. Every time you're 30 days late on an obligation, you're dinging your credit report. Your credit report is going to take a hit. When you're 60 days late, your credit report is going to take a hit. You're 90 days late. You want to make sure that you do everything possible to make sure that you do not miss a payment or that you're more than 30 days late. Now, I have people that say, oh my God, my payment's due on the 1st. What if I pay it on the 10th of the month? Well, then you're only 10 days late. You are not reported as a late to the credit reporting agency, Equifax, Experian, TransUnion, until you have hit that 30-day mark. And that's when it really starts to impact you. The biggest one that I see that kills a lot of people, guys, and this one hurts me the most, because again, I'm trying to get, especially people of color, to get qualified for a home. The one that hits me the most, the one obligation that we will let go to the wayside, and I especially see this in communities of color, is student loans. We'll pay the car note because we know we got to have a car. We'll pay the rent. We'll pay the mortgage because we got to have a roof over our head. You know, the one thing that we know we don't have to pay, you know, if you miss a student loan payment, I mean, they're not going to come confiscate your degree. So a lot of people will not make their student loan payments. The problem is that that's probably the easiest program to get help for. So I would tell you, I've had people that literally cannot qualify for a mortgage because they let their student loans go. And they just let them go into default, and then they're ready to buy, and they didn't pay that. And that probably, I mean, you have almost 5 years of forbearance. So if you get in trouble with a student loan, please, please, please do not just walk away from it. First of all, don't walk away from any obligation. Any obligation, if you're getting behind, talk to your lender. Keep in mind, guys, lenders are lending money. Their goal is to earn interest on the money. The bank that you're paying 3% to for that $260,000 mortgage, if you look at your savings account interest rates, they're like 0.10. The bank is making a spread. They're paying you 0.10, but they're lending it out at 3%. They're making a spread on that. They're in the business to earn money. They don't want the asset. They don't want the obligation. They don't want the car back. They don't want the house back. They don't want you to default on the credit cards. They will work with you if you find yourself in a bind. And what I do see a lot is that people will run away from the obligation instead of just taking it head on and talking with them and saying, hey, you know what? These are my options. I mean, I don't know a bank or a lending institution out there that does not have some type of program, workout programs, to help people to not default on their debt. So please, please, please make sure you take advantage of those options that are available, okay? Because what you do is you hurt yourself here when you let these obligations go, and then this stuff stays on your credit report for 7 years. So it literally precludes you for a period of time, you know, from being able to, you know, to purchase and take advantage of an opportunity. So definitely, if you find yourself in trouble, and we've all been there, there's not a single person that's over the age of 18 that, or obviously I won't say 18 because they're new. There's nobody over the age of 25 that hasn't had some rainy period in their life where, you know, whatever happened, things didn't go the way that they needed to go. We've all been there, but do not run from the obligation. Do your best to work out the plan, to work with people. Do everything you can do to avoid having a 30-day late on your credit report, because it really does impact your score. It impacts your ability to qualify for a mortgage. I mean, it impacts so many different things. I wish when I was in college, I remember I got into so much credit card debt when I first started, because I don't know if you guys remember you're in college and you're grown, you're all excited, and they had, what was it, Spirit Week or whatever that first week, and the parties are out there and they're giving you the t-shirts. I'm so glad they don't do this to the kids now. This is mid-90s when I was in college, and you know, you're walking down, and what did you see? At every single booth when you're walking down the thing, you just want to go to the parties and hang out and have fun, join the fraternities and sororities, and everything you see is credit cards. And Discover wants to give you a credit card, and Sears wants to give you a credit card, and Citibank. And I remember my first 2 credit cards was Citibank and Discover. And I just, in the 95, and I mean, I had a job, but I mean, I'm in college, and bam, here I am. I didn't even turn 18. I didn't turn 18 until November of 95. And I remember getting these credit cards. And before I was 18 years and 2 months old, I was almost $3,000 in credit card debt, okay? Because what do you do when you're 18 years old and I'll just pay for this later. And you buy the pizza and you buy the or whatever else you could buy or whatever. And you just, before you know it, man, I had a Sony stereo system and I had a PlayStation and I had all these things. And it was so cool. And I'm playing video games and I'm doing all of this stuff. And I have this stuff. And I'm also $3,000 in debt. Before we even got, before we got there. And so many of you guys have that same story or share that similar story. And debt is a very easy thing to get into and extremely difficult thing to get out of. So anyway, I brought all of that up just to say, again, we've all been there. Make sure we pay those obligations and go from there. Any questions so far on anything else I've covered? Because I'm ready now. I'm a little over about an hour and 15 minutes in. Like I said, I only wanted to teach for a little bit of time, and I don't want to give so much that I don't want to bore anybody. So do we have any questions or any concerns or anything like this at this point?
Could you repeat what you were saying about those of us? So I have student loans, and they're gonna be looking for, like, they want to know about like the repayment plans and things like that. Can you repeat what you were saying about the income-driven repayment plans? Like
yes.
the
Yes.
long-term bigger picture with like going to get a mortgage later on.
Okay, perfect. So, and I see this for a lot of teachers, a lot of social workers that are, they have quite a bit of debt for student loan debt, 50, 60, 70,000, but they're making 35,000 a year. There are some people that have $60,000, $100,000 in debt and they pay $30 a month on their student loans because it's based upon a calculation of what your income is. So for a mortgage looks at what is called a fully amortized payment, all right? So an income-driven repayment right now is basically saying that based on your income right now, this is all that you can technically qualify or technically afford to pay towards your student loans. So they allow you to take that income-driven plan. I don't know a single person that is offered an income-driven plan that hasn't taken an income-driven plan. Why pay $500 a month on your student loans if they say you can pay them for $40 a month and you're still in compliance? 99% of people that qualify for income-driven is going to take the income-driven option. But from a mortgage standpoint, they are going to do what is called, they're going to do a fully amortized. So what would the payment be if you were not in an income-driven loan? Okay. So again, we're going to take that percentage. So let's say you owe $60,000. You have the standard repayment plan on a student loan is 10 years. Okay. That's the standard. So most of you, if you're not in an income-driven and you're in a standard student loan, all right. I went to school for math, not spelling, so I think I got this right. Bear with me. Okay, standard. If you're in standard, you're mostly in a 10-year repayment plan. You do have the option to go into what is called an extended. Means that you're extending the payment plan out to the longest possible term. And if I'm not mistaken, I think it's 25 years. I think I heard there are a couple of lenders that have a 30-year option, but most of them that I know is just that you're extending it out to 25 years. So you have what is called a standard repayment plan, an extended repayment plan, and then of course the new one that came out under Barack Obama is the income-driven repayment plan. This is the one most people take, but when you're looking at a mortgage, you're going to get qualified on either the standard or extended. So usually you're going to want to call the lender and say, if you're trying to get qualified for a mortgage, you do not, even if you're on an income-driven repayment plan, I want to make sure I stress this. You do not have to come off of an income-driven repayment plan to buy a mortgage. We just need to know what your monthly payment would be if you were in a fully amortized student loan. So you can stay in an income-driven student loan. You can continue to pay the $60 a month. But when we qualify you for qualification purposes, we're going to want to know what that payment would be on a fully amortized loan. And I tell all my clients, sign up for the 25 years, tell them what would my payment be under an extended payment plan, okay? And if they come back and they say, well, you're paying $30 a month now, but under an extended payment plan, your payment would be $350 a month, then we would qualify you at $350 a month for your student loan payment. Okay. That answer the question?
Yes, that helped a lot. Thank you.
Okay. All right. And then feel free to definitely call me. If you have anything like, particular or definitely that, drives down to just your particular situation, I think, Shai, we're going to put my business card or information up there. Oh, okay. Perfect. That's fine. That's the other one. Yeah. We'll put my information up. And that's, of course, Sarah put it out. You can always call me or reach out via email or whatever with any questions that you may have that may be on a particular situation, or if you just want to talk privately about different options or just where you stand, I'm more than happy to do that as well. Any other questions or any other concerns? Is Sarah on the call? Hey, Sarah?
Yeah, I'll put your contact info up in the chat. I'm trying to copy and paste it now.
Got it. Okay. All right. Was this helpful to everyone? If you found that this should be helpful, I mean, there's so much more that I can cover. I mean, if there really is, well, we could really, I mean, I could be at this, I've done this actually in a 6 to 8 hour format. And there's so much that we can cover, so much that we can go over. But like I said, I hate 2 hour Zoom, so I did not want to go longer than that. I wanted to open it up for questions and answers. And if there's questions, great. I'm happy to answer questions. But if not, you know, like I say, if you want to reach out to me privately, you definitely can. Sarah, is there anybody typing any questions or anything along those lines?
I have a question.
Sure.
So I'm relatively new to Madison, but it definitely sounds like this is like a very hot market. Can you tell us, like, is there things that we should really be thoughtful of or be cognizant of looking into this housing market? It just feels like there's a lot of pressure, or people are like, man, you know, like maybe you need to get into a house because real estate is just going to continue to increase, because that seems like to be Madison. I just would love to hear you and Sarah's thoughts, just in general, just to, you know, things that newbies or new people here, or, you know, should just be aware of or think about. Advice.
Okay. I'm gonna dive in really quickly. Sarah's definitely gonna handle the real estate component of that, and she knows this. I mean, obviously, yeah, the entire country right now is a hotbed because we have basically what you like to call the perfect storm. You have the most affordability factor right now because interest rates are at the lowest that they've ever been, ever. So every time an interest rate goes down, your ability to qualify for housing continues to go up. So every eighth of a percentage point, and interest rates are based on eighths. So every eighth of a percentage point that you're getting lower, each time you drop an eighth, there's more qualification or more housing that you can qualify for. I can tell you the biggest thing that I see for people, and this is the biggest thing that I teach to know, is if you're looking at a house, you need to look at and see what the property taxes of that home are, because that can be the difference between your ability to qualify for it. You could look at a home that's in the exact same area. Let's just say in the west side of Madison. You could be on one street and the property taxes on that house could be $4,500 a year. You can go 2 streets over and look at a house and the property taxes on that home could be $6,000 a year. That's a $1,500 a year difference between the two. That's probably going to be your biggest swing or your biggest shift in your payment. So definitely, when you look at houses, make sure you're not just looking at what the purchase price is, know what the property taxes on that home are, because that's going to probably be the biggest swing in your payment when you're comparing apples to apples. I've had people that looked at a $250,000 house that they didn't qualify for. We couldn't get them in a $250,000 house, but we were able to get them into a $270,000 house. And the first thing they're like, well, how do I qualify for the 270 house and I don't qualify for the 250 house? And the big difference right there was the property taxes. The property taxes on the $250,000 house were way higher than the property taxes on the $270,000 house. And even though they both had the homestead exemptions, they weren't investment, just they were an apples to apples comparison. It was just, that was how the mill rate, the assess rate that the county came up with, the property taxes were cheaper and they were able to get the bigger costing house. So I always teach all of my clients, know the property taxes of the homes that you're looking for. That's a very important figure, because that's outside of the principal and interest, the property taxes is the next biggest expense when you're breaking down the cost of your mortgage.
Can I throw something in here too?
Absolutely.
Okay, so sometimes when we're looking at houses, the assessment is how they base the taxes. So the city assesses a property and then they use that percentage to give you the taxes. The appraisal is what the lender orders to appraise the value of the home. So your assessment might be $250,000, and so you might be paying taxes based on the city assessment of $250,000, but you might be actually writing an offer for $280,000 or $290,000. It might be appraised at $280,000 or $290,000. So what we also need to look for is what will the taxes go up? So like the next year, your taxes are probably going to increase based on how much you paid for it. And if we're not watching out for that, that can get that can be a surprise, and we're trying to avoid those kinds of surprises.
Absolutely. Absolutely. Very good point, Sarah. Thanks for throwing that in there as well. We definitely want to look at that. But, and as we said with taxes, the second biggest expense outside the principal and interest that you pay to the bank is the property taxes. So we definitely want to look at that. Did that answer your question?
How about some questions around what are like your 3 biggest tips if someone's looking to increase their credit or improve their credit? Like, what could they do today?
Perfect.
I was just about to ask that.
Okay. The biggest one is what we talked about, payment history. The biggest jump for anyone. So we said 35% of your credit score is your payment history. So the very first thing that I'm going to say, believe it or not, your credit utilization ratio. And when I talk about, and there's a credit, I could do a credit class. I could spend 2 hours on credit. I really wanted to just kind of dive into mortgages. I probably spent actually 8 hours on credit. It's unreal. When you have a credit card, 1/3 of your credit score is what is called your credit utilization ratio. And nothing impacts your credit utilization ratio like a credit card, okay? I like to use this analogy about a bank, and it's the God's honest truth. A bank will lend you an umbrella when the sun is out shining and ask for it back when it rains, okay? Meaning, and what does that mean? Banks love to give you credit, but to a banker, and I see this a lot in our communities of color, we get offered a credit card for $10,000. And we're like, man, the bank really trusts us. Man, they got a $10,000, I've got great credit, and we're using it, and and it's great. And we use it because it's given to us, okay? If the bank gives you a $1,000 credit card or a $10,000 credit card or a $500 credit card, the minute you put more than 20% on that credit card, the bank is saying, oh my God, they're broke. They are in trouble. And it doesn't matter unless you need to pay that off quick, because they're looking at it. If you have a $10,000 limit and your balance is $9,000, to most of us, it's like, okay, you know what? If they said I can afford that. I carry $9,000 balance, but I make my payment every month. It will impact your score because the bank is looking at it. If you have $9,000 on a $10,000 credit card, you are broke, because who would carry a $9,000 balance at 17, 18, 21% interest unless they had to? So in the bank's mind, if you're borrowing, we all know most credit cards are double-digit interest rates, 14.99, up to 22.99. So in the bank's world, if you're carrying a balance on 22.99, you're only doing that for one reason: you have no money. Because if you had money, you wouldn't carry that balance. Okay. So the biggest one is credit utilization, and this is probably the way to see the biggest jump in your credit score. Is look at your balances to your credit cards. If you have a credit card and the limit on that credit card is $1,000, and let's say you have another credit card and the limit on that one is $2,000, and let's say you have another credit card and the limit on that is $5,000. The quickest and fastest way, that's $8,000. The quickest and fastest way to kick your credit score up, and you hear where you have people like, oh my, I did this in the 60 days, my credit score jumped 90 points. 9 times out of 10, they were carrying balances at like 95% of their debt utilization. And then they paid that off. So you went from, in the bank's mind, every time you're over 20% of your credit utilization, it's impacting your score. So if you have a $1,000 credit card, if your balance is $0 to $199, you're fine. The minute your balance goes to $210, it's impacted your credit score because you're over 20% of your credit utilization. Okay? Have a $310 balance, it affects it even more. You have a $510 balance, now you're using 50% of the credit card. Whoo, your score is it's dropping. I have tons and tons of people that I talk to that have 580, 590 credit scores, and they've never missed a payment on anything ever in their life. They don't have a collection. They don't have a charge off. They don't have a bankruptcy. They have nothing. They have a flawless credit reporting history, but they are maxed out on every single credit card that they have. And in some cases, they owe more than the actual limit. So the limit might be $1,000 and they owe $1,100. That is the biggest red flag. So the fastest way and the quickest way to get your credit score up is to pay down your credit utilization, to pay down your credit cards. It reduces your credit utilization ratio. So if you have a balance here, 1,000, you owe 100, 2,000, you owe 200, 5,000, you owe 500, your credit utilization is 10%. You owe $800 against your $8,000 limit, your credit utilization ratio is 10%. That's a very good credit utilization. You get to 90, and I don't know if I'm about to age myself. Remember Lost in Space, the robot that was hollering at Will Robinson, danger, danger, Will Robinson? That robot is hollering to the bank, danger, danger, banker, danger, danger, banker. This person had 90%, they're broke. And it's usually, and that's where your credit score starts to go into the tank. So the number one quickest, fastest way to up your credit score, if you have credit cards, is to pay down your credit cards. Don't pay them off. Do not pay them to zero, because if you pay them down to zero, then you have a zero credit utilization. There's nothing for the Fair Isaac to score. I have all my clients, if they have a zero balance, I say, go buy your kid a pizza at Pizza Hut or whatever, put a $10 balance on the card. You have a $10,000 limit, but a $10 balance, you now have a 0.10, okay? Why do I say that? Because there are people that don't have any credit cards whatsoever, and they still have a low credit score because they don't have nothing. 35% of your score is your credit utilization, and if you don't have a credit card or you're not using a credit card, there's nothing for it to score. So the next biggest thing that I see is I've had a lot of clients that have credit scores in the 550, 570, 580 range, and they pay all their bills on time, but they have no credit card. I had one lady go apply for a Capital One credit card. She got a credit card with a $500 limit. She went from a 550 to like a 677 in the course of like 30 days because of the simple fact she had a credit union. She had something in the system that was scoring. So my number one tip, either completely get those credit cards paid down to that 10% tolerance. And if you don't have a credit card, go out and get you one ASAP and keep a $10, $20 balance on your credit cards. Do not match your credit cards out.
Okay.
We look at it as a good thing. The bank does not.
Hold on. Alyssa, why don't you want a credit card?
Because I got one in college, the student visa, and messed it up and closed the account. And so now I'm like, well, I shouldn't do that again.
Okay.
Yeah, I agree. But again, coming back to what I was saying, we all have messed up before, okay? I was telling that story about my Citibank and my Discover. When I finished college, I was almost over $20,000 in credit card debt. Do I carry credit cards today? Yes. The difference between now, Alyssa, and what you did then was because then you didn't know. And now you know, and now knowledge is key. So I'm not telling you to get a big credit card. You can get a credit card as much as $200 limit, okay? And if you're really concerned about this, you can go to one of the local credit unions. Are you in Madison?
Yeah.
You could go to Heartland, Dane County Credit Union. You can set your limit. You can say, hey, I just want a $200 credit card or $500 credit card because I don't want to get myself in trouble, okay? And you can do that where you don't, do anything big. Put $10 on it and don't use it. And have, the discipline of it to say, you know what, I'm not going to use it. I was telling somebody this story. About 6 months ago, I took all my credit cards and I put them in a perfect little hiding space, okay? And I hid them so well that I can't even find them anymore. I haven't used my credit cards for like 4 months now. Now I've got a 2-year-old. I'm pretty sure she has found my little hidey hole, and that's why I can't find my credit cards anymore. But I can't find them. I've been using my debit cards for like the last 4 months. My credit score has been going up because I've been paying my credit cards down, and I'm not using them. You don't have to use it. You just need to have it. So you can get the little credit card, keep a little small balance on it. I've seen people put their credit card in a Ziploc bag, fill it up with ice, and put it in a freezer and freeze it. I mean, all different kind of things that people do. I don't want you getting in trouble, Alyssa, but at the same time, I don't want you to miss out on what could really impact your credit score. So what I tell people, and I've had people that feel like exactly like you do, they are just credit card averse. I don't want anything to do with a credit card. And I know that there's some financial advisors that teach, don't have a credit card, stay away from credit card. I'm not advocating credit card debt at all. I'm just advocating having a credit card so that your credit utilization score will be there. Me personally, I'd say don't owe your credit card company more than $10 a month or $10. Have a very tiny balance, but you want to make sure that you're at least getting on that credit utilization ratio. It will make a difference in your credit score.
So should she pay off her closed card then before securing?
Oh yeah. Oh yeah, that's paid off. But I'm just so scared. I don't. And then I thought about a secured card because I didn't know.
You're
Somebody?
Oh,
Oh,
Alyssa, you went on mute, but you were asking about the secured credit card.
Right. Yeah. Sorry.
yeah. I do know if you, I mean, again, not promoting the credit union, but I know there's a few credit unions here that do offer. UW has one, Heartland has one, Members First, I think, has one. I don't know if Summit has one or not, but check with the local credit unions. I know Dane County has what they call a secured card. And you may not even necessarily have to go secured, but with a secured card, you can set your limit so that you know you're not getting yourself in trouble. So the bank may say, oh, I'm gonna give you a $3,000 limit. And you're like, no, I only want a $300 limit because I don't want to get myself in trouble. I don't want to pay off something more. There's nothing wrong with that. You're going to get the same credit utilization ratio because it's working off of a percentage. So whether you have a $300 limit, a $3,000 limit, or a $30,000 limit, the amount of that you're using to the ratio is going to be the same. The algorithm is just picking up, the FICO score algorithm is not picking up the balance, it's just picking up the percentage of the credit that you're using. So you could have a $300 credit card, not get yourself in trouble, and still get the same, to get the advantages and the benefits of using the credit card and getting the credit utilization ratio. Most of the people that I know that have 800 plus credit scores have very high credit card limits and very, very, very low balances. Okay. I mean, it really is a huge, yes.
Here's another thing is that in everything that you're talking about, LeMar, it's about how we can use the system. So knowing that the system is trying to get us into credit card debt and get us under that in those high percentages and impacting our credit, with all of the knowledge that we have in knowing how to use it and knowing, like Alyssa, like you learned, and like you said, LeMar, we've all been there with the credit card debt, except, I mean, most of us have. Now, how do we take that next step to believe in ourselves? What kind of evidence do we have in our lives where we have done hard things, where we have used our discipline? Because I think there's also this message that we can't do it or that we will get sucked into it. And when we have accountability partners, or when we have, you know, like when we write down our goal, so like let's say every 3 months we're going to check on our credit score, how can we change that narrative so that we can use credit cards in a way that's going to benefit us and not the other systems, and not paying into? Do you know what I mean? Does that make sense? That's one of the questions that I like to, not that I'm asking that question, but more like we can ask ourselves, wait a second, what do we need to do differently so that we're not doing what we did because we learned that lesson? So then instead of just not using credit cards at all, how can we use credit cards to benefit us for the future? Because they can really help in increasing our credit quickly if we know how to use it right. Yeah.
Absolutely.
That's what I hear you.
Go ahead, I'm sorry.
Well, that's what I hear you saying. I'm just trying to understand, because I do hear a lot of people, I mean, like, that don't want credit cards at all, or even don't want mortgage debt, you know, like, oh, I should pay my house off. And there is a way that you can have really low interest rates in your home mortgages that can even be a better benefit than just paying it off completely.
Let me say this really quickly, Sarah. I've used this analogy. So I used to do a radio show when I was in Nashville. And we did a radio show every week on a Wednesday. And this was back in 2005. And this is right when Katrina hit. And a good friend of mine, we had a mortgage radio show. And one of the things that we talked about, this is kind of getting off the mortgage component, and I probably need to teach you to do a get credit ready, or kind of do like a credit, or just focus on credit. But one of the things that we talked about, and I'm so glad that you brought that up, was utilizing tools. So everyone that thinks that when Katrina hit, that everyone that stayed behind in Louisiana, that stayed behind, was because they were poor and they had no money and they couldn't get out, okay? The vast majority of the people of color in Louisiana owned their home, and they owned it free and clear. And most of those people had a house that was probably worth anywhere between $80,000 to $100,000. So even down in areas like, you know, what is the fifth, well, I'm trying to think of NOLA, but the ninth ward, fifth ward, or whatever it is, I can think of the top of it. But one of the hardest hit areas was the areas where communities of color. And so many of those people owned their home free and clear. They weren't poor. They weren't broke. They just simply had their assets tied up in something that was non-liquid. And so when it came the need to be able to use that asset, they weren't able to use that tool because of the fact that they did not have the ability to access it. Now, their neighbors, their Caucasian neighbors that were just a few miles away had home equity lines of credit and had $30, $50, $70, $100,000 available to them. They were able to catch a first-class plane to Telluride, Utah, or Colorado, or wherever it is, and ride the storm out. A lot of it has to do with tools. But a lot of people that died in Katrina, a lot of people that were left behind in Katrina, they weren't broke, they weren't poor. The media was showing us, oh my God, they couldn't get out because they're poor and they're impoverished. And some of these people had net worths that was 6 figures. It was just how was that 6-figure net worth? Where was it? It was 100% tied in their in their house that they could not access, they could not use. And I'm a big advocate of that, and that's a topic for a whole nother thing. I mean, interest rates right now are 3%, and we've had, the stock market, and there's people that literally, my thing is, well, again, I'm not going to get off on that. I'm going to stay on task of get mortgage trading. But just coming to that, it really is about us using the tools that are available to us to be able to move ourselves forward. And again, whole nother topic, but another time. But you made a very good point, Sarah. It's about using the tools. I totally understand where she's coming from of not wanting to be using a credit card. She was the type of kid, she put her hand on the stove when she was 3, she burned her hand and she never wanted to put her hand back up there. That was really smart. I was the wrong kid. I was a kid that was like, I put my hand up there, burned it, and then I put my hand back up there a second time. I was like, it can't be as hot the second time as it was the first time, and burned it again. And then I went back and tried it again and was like, okay, all right, third time, it cannot be as hot as it was. But that's me. I'm just weird like that. Some people, you have, they're, oh, that hurt. Like, nope, never doing that again. Yeah, my brain didn't work that way. My brain was a little bit different. I kept going back to the fire. But the thing is not to go back, but it's going back with the knowledge and going back to the knowledge differently. So get back on board, ride the horse again. But when that horse throws you off, now you've got a little bit more knowledge of how to ride that horse a little bit differently.
Okay, question, LeMar.
Yeah.
When we do have that situation where our credit cards are maxed out, who do we trust to help advise us in terms of, because if we can't pay off the credit cards, do you consolidate them? Like, where do we go for that information?
Sure. I guess everybody's situation is different. If you own your own home and you get in credit card debt, you may have access to your equity where you can consolidate them. I remember when I first got in credit card debt, I bought my first home I lived in Nashville, Tennessee for 7 years, and I bought my first home, and I had a little bit of equity, but not enough to really do it. So I got a second job and just worked on, at that time my daughter was not yet born, so I didn't have any kids at that point. So I worked a second job, and then even after my kid was born and she's like 3 years old, I was going around, I worked my way out of credit card debt by working a second job. There are things that you can do. I had a young lady a few years ago, she was trying to buy a house, and she's like, I can't afford $150 a month. I was like, girl, yes, you can. You better fry some chicken on Friday or some fish on Fridays and sell some fish dinners or whatever the case there's so many different ways that you can be creative to come up with ways to generate the income to pay off the debt. So if you have the ability to debt consolidate, great. If you have the equity in a home and you can go get a home equity line of credit at 1.99 and pay off your credit cards, great. But if you don't have those tools, then we need to get creative in how we look at different things. And there's so many different things that you can do to be able to raise money. I have a 2-year-old, and we're selling her clothes. Me personally, I would have just put them in a bag, took them to St. Vinny's and been done with them. But we're selling her clothes, and as far as I know, she's making some money off of selling the kids' clothes and different things that I would not have even thought of. So there's so many different ways to just get creative. The main thing is put together a plan and execute the plan to work on getting that credit card debt off. And I would start with the snowball effect. Snowball effect means you start with the smallest to the largest, you pay off that small debt. Once that's paid off, you use the money that you was paying on that one to go to the next one, and the next one, and the next one. But there's ways to do it. The biggest thing is little small changes over time will add up and make a big difference. So we can definitely talk about how to do that through different means. And if you want to talk about it, in detail, or you have a particular issue, more than happy to talk to you about that outside the class.
Awesome.
Any other questions? Yeah.
I don't have. Nancy has a question.
Yeah. So I was actually wondering if there were any other courses that you taught, or if there was any non-credit courses through like the Urban League or something that we can take so that we can be, or just stay informed.
I'm going to answer that one, okay?
Yeah, I was going to ask you to.
So Nancy, we have just this past year created this group, and our goal is to add more education. And so now that you've registered for this Zoom call, we will be sending an email out, and we'll make sure you're added to the list so that you can know of upcoming events. But we do want to keep educating, and we will, I mean, like, that's one of the main goals. So yes, there will be more. We're not sure exactly when the next one will be. And we'll be also looking for feedback in terms of what what you want to learn more about, so that we can continue to provide information that is relevant. And because financial literacy is just so crucial. It's so crucial, and there's just not enough education around it. So is that helpful, Nancy? We will get that information out to you. And then just to reiterate, the group is within Dane County. We're a group of people within the real estate industry, realtors, lenders, brokers, and the mission is to empower, educate, and guide Black, Indigenous, people of color, future homeowners in the community in building household wealth through real estate homeownership. And we're doing this through advocacy, education, and addressing systemic racism in the real estate industry by eliminating barriers and empowering Black and Brown communities to create generational wealth through real estate. Because we see it working all the time. And I want to introduce, I just want to mention Antoinette is on the call right now. If you want to say hi. Oh wait, maybe she jumped off. And Tiffany Malone is here. Do you want to say hi, Tiffany?
Hi, my name is Tiffany Malone, and I am in this wonderful group with Sarah and LeMar. I'm an agent at the Alvarado Group. I'm also an advocate for home ownership for minorities, single women, and educating.
Can I get information?
Sure. I can put my information in the chat.
Okay.
Jasmine, I'm glad you liked the event. I'm glad you're here. And just also know that we can answer any questions. You don't have to wait for the next educational opportunity or event to reach out to us, because the goal is to create a resource, not just education in terms of group events. That came out privately, hon. You're gonna have to send that again to everyone. But yeah, so that you can know who to call, and you can know, and a lot of times if you do connect with one of us, we have a ton of resources so that we can then send you to the right people. A lot of times it's about connections, and some of this is like, especially when you get into the home buying process, it's creating a team. So you find a lender that you trust and that is gonna give you the right kind of information, and not just tell you how much you can qualify for, but talk to you about what you can afford and what you're comfortable paying versus how much you can qualify for. And also a realtor, you're gonna need to, and then the realtor might connect you with a home inspector. And then you might also at some point during the process need to connect with an electrician, or like all of these ways of creating your team to get you where you wanna go is community-based. And that's why it's so important for us to have a stronger community around that. So that's what we're here for. Oh, Antoinette, you are here. Do you want to pop in and say hi? I see you.
Yeah, sorry, my computer died, so I had to run and put it on the charger. But yes, I'm a realtor with First Weber. I am a part of this group also, and I'm just glad to be here because the information that LeMar spoke upon is very important for all of us, and for us to take our home buying step and make that a success. That's an investment and not just a house. So yeah, that's what I have.
Yeah. Thank you for being here. All right. Does anyone have any other questions? You can ask anything. There's LeMar's beautiful face. Yeah, you can find us on Facebook, and I know Antoinette's on Facebook and Tiffany's on Facebook. So stay connected. Thanks, Tenzin.
All right, perfect. I really enjoy doing this. I really enjoy, sharing my knowledge and bringing this. And if I can help in any way, I mean, that's, I'm a part of this group, again, for our mission statement, which is to empower people of color and Black and Brown communities to change the landscape and to go from, to bring about that generational knowledge. Not that we only have this, but that we're passing this information and this knowledge down to our children and their children and the next generation, and to kind of change this shift from have not to have. So I'm hoping that you guys really enjoyed this event today. It's a little different for me because, again, I usually teach it live and not through a Zoom. So it's a little bit of a difference for me, but I hope it was informative. I hope that everyone here got something out of it. I'm more than happy to do a credit one or answer any questions in any shape, form, or fashion about anything. But thoroughly, this is my passion. I love this, and I love helping people to become homeowners and helping people to take it to the next step. So if I can be helpful in any way, or Tiffany, Antoinette, Sarah, if we are, and all the others that are part of our group, if we can help in any way, that's the whole reason why we got together, was for this same mission, this same purpose, and we're here to help in any way that we can.
Yes. And we will offer this same one again. This is not just a one-time thing. It is recorded. We will send that out. But if you're like, oh my gosh, I wish that this person could have seen it, or your friend or your family members, we will offer this again, and we're hoping to maybe make it a quarterly thing. But again, this was our first time, so we want to thank you all for coming, and I'm glad that you all enjoyed it. So with that, I think we're gonna end the recording, and wish you all an amazing day.
Yes, enjoy the rest of your day and have a great, wonderful week. It's going to be a beautiful day. Let's get out and enjoy it. Thank you for having me. Take care.
Thank you. Bye, LeMar.
Bye-bye.
Good day, all.